Welcome to This Explainer. Today, we're dissecting the reality of Bank of China as of August 21, 2026, and we're going to solve a multi-billion-dollar puzzle using only their official verified filings. No rumors, no noise, just the data. We're standing at a fascinating crossroads for Chinese financials, and the clues are right in front of us. Here's our roadmap for today: the valuation paradox, earnings reality and dividends, decoding the capital strategy, the geopolitical risk premium, and finally, strategic investor positioning. All right, let's jump right into part one, the valuation paradox. 0.38 times. That's the number we're looking at. Bank of China is literally the fourth largest bank in the world by assets, yet it's trading at a staggering 0.38 times price-to-book ratio. To put that into perspective, the market is basically saying that buying this bank is like buying a crisp $1 bill for just 38 cents. It's a massive discount. It values the bank at a fraction of its liquidation value. So, why the steep discount? Well, that's our main mystery for today. Moving on to Section 2, Earnings, Reality, and Dividends. Now look at this stark contrast. We have an anemic 2.8% year-over-year operating income growth standing right next to a premium 6.2% pre-tax dividend yield. I mean, if this were a tech company, a 2.8% growth rate would be an absolute disaster. But for a global bank, especially in a low interest rate environment with aggressive monetary easing, this actually signals some remarkable resilience. And here's the kicker about that 2.8% figure, that growth. It's not coming from traditional lending spreads. Actually, it's driven entirely by non-interest income. You see, Bank of China is executing a major strategic pivot right now. They're shifting from being just a simple lender to acting as a high-level financial facilitator, banking heavily on things like cross-border wealth management and green bond underwriting. But let's be real, what the market really cares about is the payout. The board just approved an interim cash dividend of RMB 0.185 per share. By distributing cash midway through the year, instead of just hoarding it all for a final payout, they are signaling immense liquidity confidence. Think about the broader macro environment for a second. In a global market where sovereign bonds are yielding under 4%, Bank of China is stepping up and offering a premium 6.2% yield. That's huge. But looking at this structurally, considering that super low operating growth, we really have to ask the logical question: how on earth can they afford to pay this premium yield without bleeding their core capital absolutely dry? Well, this leads us right into the cost of that dividend. Which brings us to Section 3, decoding the capital strategy. Just today, August 21st, the bank closed book building on an absolutely massive 30 billion yuan Tier 2 capital bond. Now, usually huge debt issuances scare equity holders, but check out these terms. An incredibly cheap 3.15% coupon rate. Demand was actually so oversubscribed that it closed lower than their initial guidance. The market is perfectly willing to lend to them at near risk-free rates. Crazy, right? And this brilliantly illustrates the concept of strategic arbitrage. They're essentially leveraging this super cheap 3.15% debt to protect their core equity Tier 1 ratio, all while simultaneously rewarding their equity holders with that juicy 6.2% dividend. It's a highly deliberate, highly calculated maneuver. They keep shareholders happy while perfectly managing their internal capital requirements. However, you've got to keep your eyes wide open here. This is a critical warning bell for value investors. You need to monitor their Q3 2026 filings very closely. If we see the payout ratio creep above that 70% to 75% mark, that's a massive red flag. It would signal that the bank is struggling to generate organic capital internally to combat net interest margin compression. Basically, this bond issuance buys them time, but it doesn't cure the underlying margin pressure. Let's dive into Section 4, the geopolitical risk premium. This brings us to the elephant in the room. Bank of China handles roughly 70% of all Chinese yuan to US dollar cross-border settlements. They are literally the primary pipeline for global trade in this corridor. But you know, that monopoly is a double-edged sword. It makes them a massive target during times of geopolitical tension. So that 0.38 price-to-book discount we talked about, it is quite literally a geopolitical risk premium. And the geopolitical heat is very real right now. Just yesterday, they took the rather unusual step of issuing a public statement on Weibo. The explicitly refuted rumors circulating about a complete suspension of US dollar clearing for Russian-related transactions. So they're having to actively manage the narrative around their international operations in real time. Yet in stark contrast to those market fears, look at the reality of their filings. For the third consecutive year, their New York and London branches passed strict anti-money laundering audits by the US Federal Reserve and the UK PRA, with, quote, zero material deficiencies. I mean, that is a pristine, multi-billion-dollar compliance moat sitting right in the middle of a geopolitical storm. Finally, let's wrap up with Section 5, Strategic Investor Positioning. Here's the ultimate bottom line. Bank of China is not a speculative growth stock. That anemic 2.8% operating growth proves that beyond a doubt. Rather, it's a defensive income play. That massive compliance infrastructure acts like a fortress, securing their settlement monopoly while they distribute those high yields. So, how do you actually apply this to your strategy? Well, if you're an upbeat dividend seeker, that 6.2% yield looks pretty safe for the next 12 months. Your strategy should be to buy on dips below the HK 370 level just to lock in that return. On the other hand, if you're a growth or pure value investor, you really need to exercise caution here. Without massive macroeconomic fiscal stimulus, this could easily turn into a value trap. You should probably hold your current positions, but avoid overweighting them for now. And here's your immediate action item to take away from this explainer today. Mark your calendar for September 20th, 2026. You need to watch the PBOC's loan prime rate decision. If they issue a rate cut, that means further net interest margin compression, and you should probably rotate out. But if the rates hold steady, that's your clear signal to accumulate. So we've solved the mystery of their deeply discounted valuation. It's a complex blend of slow core growth, strategic debt management, and a heavy geopolitical risk premium, which leaves us with one final question to ponder. In an environment full of global noise and uncertainty, is the Chinese banking sector's safest risky bet the right anchor for your portfolio? Thanks for joining me on this explainer. Keep a close eye on the data, and I'll catch you in the next one.